Thanks everyone for joining us today. I can't believe that it's already September. It felt like the summer just went by in a blink, but by the way the weather's been going here in Toronto, it looks like that summer is just arriving. As many come back well rested from vacations, and July and August is generally a relaxed couple of months, we've always viewed Labor Day as the unofficial start of the new year. As always, I have joining me today again is Gareth Watson, Director of our Investment Management Group at Richardson GMP. Welcome and thank you, Gareth.
My pleasure. Great to be here.
Gareth will discuss and review what has happened around the world over the last 7 months and what we anticipate going forward, along with what we should be looking out for in the next couple of months before the end of the new year. Before I hand it over to Gareth, I wanted to provide a quick recap of market numbers, along with high-level overview of the Canadian landscape, along with what's happened around the world. So first off, we'll look at some numbers. As of September 1st, the S&P TSX Canadian market was one of the best last year, but this year it's now one of the worst markets with a negative performance as of September. The U.S. markets has had another strong year so far, up 10.4%. But due to the strength of our Canadian dollar, you can see that this has muted the returns for Canadian investors of about 2.8%. We'll discuss this more in detail as we go through the presentation. The international markets, as measured by the MSCI Europe, Australasia, and Far East indices, has finally turned things around and has been a great contributor to our portfolio with a 14.7% return. But again, for Canadian investors, this has been muted down to about 6.8%, again, due to the strong Canadian currency. Emerging markets are also back on track with a 26.1% return year to date. For Canadian investors, that's 17.5. Even with this run up in this region, it provides a compelling view on valuations relative to the U.S. We'll also address this later on in the presentation. The bond market measured is interesting enough is positive for the year, even though our Bank of Canada Governor Stephen Poloz has raised the short-term rates twice in the last 2 meetings. The last one, many were caught off guard, and this will also be discussed. WTI has been floating around in that 47-49 range throughout the year, which for the year it's been negative. And our Canadian dollar at the time in September was trading at levels not seen in 2 years relative to the U.S. in September. Beginning of September, it was at about 78.95. Currently, it's at about 81.5 to the U.S. All this has been attributed to the rise in interest rates, both on the short-term rates and the longer-term rates, as you can see in the 10-year bonds, where 10-year bonds today is over 2%. It's at 2.08%, and the 10-year U.S. Treasury bonds is at 10.22%. Interestingly enough, some of the major events in 2017 is actually coming from Canada. One being our economy grew at a whopping 4.7%, driven by consumer spending. This led to the Bank of Governor, as we mentioned, Stephen Poloz, to raise rates second time in 2017. As mentioned, this was a surprise, and it actually garnered some complaints about his lack of communication on this. As we all know, the markets do not like surprises. This has then led to the strong surge in the loonie that I had just mentioned. The next area is the housing market in the GTA, which has cooled down. It seems like the real estate market is showing some semblance of common sense to a certain degree. And the last bit of major events in 2017 is the feud between the U.S. leader, President Trump, and his counterpart in North Korea, Kim Jong-un. We're all hoping that common sense and cooler heads prevail. So lots of meat to sink our teeth into today. I now want to hand it over to Gareth to discuss the markets and the economy in a little bit more detail. Gareth, the presentation's yours.
Thank you very much, Frank, and thanks again to everyone for joining us today. The format for my presentation is, if you've tuned into a few WebExes before with Frank and I, it's very similar. I tend to go through the same format just because it's an easier process to follow. So I'll touch on mainly Canada and the U.S. here today, but I just want to revisit a couple of themes that we had at the beginning of the year. Right now we're in September, so we're well into 2017, and I'd like to kind of go back to the beginning of the year to focus on some of the themes that we looked at as being important for 2017 to see whether or not they have developed or not. And for the most part, things have actually unfolded relatively as expected. There's some areas, of course, where things have differed, but for the most part, I would say that some of these themes have well, to be blunt, come true in terms of our expectations. I mean, the first one has to do with economic data. The U.S. Still remains very strong from an economic perspective, even though we do have a lot of politics out there, not just in the U.S., but also in Europe and over in Asia that have been acting as distractions, but the underlying fundamentals have been quite strong. And to be honest with you, as Frank alluded to earlier in the call, the economic data out of Canada has been very surprisingly strong. I'll get to that when I talk about the Canadian slide, but for the most part, the underlying fundamentals in North America have been strong. In fact, we're also seeing a great deal of improvement coming out of the European region, which of course has been in the doldrums for some time. It is finally coming out and emerging from the recessionary period that it's been through. So on the whole, globally, not just within North America, we're seeing some improving statistics. Secondly, of course, we thought earnings growth would continue. We did not foresee a recession in the United States or Canada. That certainly has come true. We're nowhere close to a recession just based on economic data alone, not to say that one can't happen, let's say in 2018 or 2019, but certainly in 2017 it's not in the cards. We thought there would be a focus on the Federal Reserve, and that has been the case, although other central banks have been taking some headlines here, the Bank of Canada with the unexpected rate hikes that we've had. The Europeans, while not raising rates, are hinting that maybe at some point in the near future they'll start reducing some of the monetary stimulus that they have. And I'll have to admit, when it comes to monetary policy taking a backseat to fiscal policy, that's proven to be somewhat true, but certainly monetary policy has received more headlines than we expected, because we actually didn't expect a great deal of change in 2017, and there has been, for example, with Canada, more movement on the monetary policy front than we had expected. Now, with respect to Canada, and I will get into more detail when we get to the Canadian slide here, when it comes to the loonie, we didn't expect it to be overly volatile. I would actually say that it has been volatile, but where it differs from our expectations is that it has been volatile to the upside, in that we have had tremendous strength in the loonies that we did not necessarily predict at the very beginning of this year. And we attribute that mostly, of course, to the unexpected rate hikes that we didn't necessarily foresee until 2018. And then finally here, the oil price environment, we do have to touch on that since we are in Canada and our market is so heavily weighted towards commodities. We thought that we'd have some stability in oil prices. That, for the most part, has come true. Yes, I mean, there's been some movement a little bit up and above and a little bit below $50 a barrel, but that has been on average where we've been at most of the year. So I think, even though, of course, oil companies out in Calgary or out in Western Canada would love to see higher oil prices, they aren't complaining from the perspective that at least they're not seeing erratic movements in the oil price or, of course, lower oil prices. So this slide I've had in my presentation for years. And for the most part, for years, beside each country was always no change, no change, no change, or to some extent also rate cuts. When I updated this slide for this WebEx today, I was kind of struck by the fact that I almost had to change every line in here because there has been movement in terms of expectations for central bank moves across the world. We have had a few rate hikes in the United States. Admittedly, I would say those were largely expected just because the Fed's been relatively good at communicating their intentions on rates. At the end of last year in December, we had a hike and we've had two more since. And there's an expectation that we could get another in December, along with, and this is an estimate at this stage, possibly 3 more next year. So they are certainly in the hiking mode going into 2018. Certainly the hikes that we've seen so far aren't necessarily going to be reversed anytime soon. Now, the United Kingdom, although they have not done anything at this stage, there have been some hints coming out of Mark Carney and the Bank of England that at some point in time in the near future, the Bank of England may need to move rates higher. Japan was the only country where we don't see necessarily a great deal of change on the monetary policy front. The Europeans are not going to be raising rates anytime soon. However, there could be more discussion about them reducing their quantitative easing stimulus. That, in terms of timing, could happen in the second half of 2017, but certainly will be something in the cards for 2018. And with respect to Canada, we did not foresee the 2 rate hikes that have come so far. We were surprised by them, and quite frankly, I think the whole investment community was. There are some economists now that are becoming very aggressive in their forecast for rate hikes that did not forecast these rate hikes literally 3 months ago.
Yeah, I reviewed our slides from the previous, and it's interesting because Canada was really probably the biggest surprise out of anybody. Would you agree?
Oh, absolutely.
Yeah. Okay.
And you know, Frank, you had touched on the fact that I don't think they really communicated this very well. There will be some that say, hey, they gave us, you know, 3 weeks heads up before the first rate hike. You usually need a lot more than 3 weeks if you're going to telegraph this properly with the investment community. So I have a feeling that the Bank of Canada does not want to get left behind. In a way, I'm actually somewhat relieved that they're finally raising rates. They've been too low for too long. If we are, in fact, seeing growth in this country, we need to get our rates back to some level of normalcy, and where they have been for so long is just not normal and not sustainable, quite frankly. And especially if we embrace the next recession with rates at all-time record lows, you know, the Bank of Canada is going to be in a very difficult position to try and stimulate the economy. So there are potentially more rate hikes coming in 2017, but certainly going to 2018, the Bank of Canada has jumped on the bandwagon here and is moving higher. So I'm just going to touch a little bit here on the States with respect to the outlook for the U.S. economy. As I mentioned earlier, the data still remains positive. It might not be as positive as it was a year ago, but it's still relatively positive. There are potentially further lifts coming to that economy if, in fact, their government can actually do anything, which recently has been difficult to come by in terms of passing bills and making progress on things such as budgets and tax changes and tax reform. There could be some opportunities here to stimulate even further growth in the U.S. If, in fact, the politicians can get their act together and get some of this legislation passed. Certainly, corporate tax cuts, personal tax cuts, while who knows if they can be sustainable, certainly do provide some short-term stimulus to economic growth. It does tend to increase both corporate and personal spending. I don't need to tell you that the employment data has been very strong out of the U.S., very low unemployment rate at this stage. The question is whether or not inflation will at least be supportive for further rate hikes. Right now, it's actually relatively low, and there are some concerns that if you raise rates in a low inflation environment, you could actually create some deflation. At this stage, that is not the case, but inflation is going to be the main indicator that I think the Fed will be paying attention to because, as I said earlier, the employment market is relatively strong. We do have a bias here for interest rates to be higher in the States, and I did hear the key is not whether or not they're going to raise rates. We've had that debate. It's over. They're doing it. The question is how quickly and how aggressive will they be with those rate hikes? We don't think they're going to be too aggressive, and I have to admit, you know, the forecasts of 1 more in December and potentially 3 more in 2018, I wouldn't necessarily call that overly aggressive. So that seems to be falling in line with what expectations are in the marketplace. And looking beyond the economy, if we actually look at the stock market, the United States has done phenomenally well. We're into the 7th or 8th year of the economic expansion. What has been quite remarkable, to be honest, since November is how little influence the market has put, or I should say emphasis the market has put on Donald Trump. There's a lot of things that he has said or tweeted which historically probably would have rattled the markets, and it seems as though traders these days are just completely ignoring what he says and are focusing on market fundamentals, on corporate fundamentals, and pushing stocks higher at this stage.
What should we look out for? Just a quick mention maybe on your end on what we should look out for from the U.S. that may kind of derail what's going on right now?
Well, probably 2 things. Number one, we've heard a lot of discussion about trade from Donald Trump, but not necessarily any final changes. So, of course, we're renegotiating NAFTA as we speak. And the reason why trade, I think, is important is because there is the potential, maybe, for the U.S. to be a bit more protectionist than they have been in the past. And once you start becoming more protectionist, you do potentially put your economy at risk, because what you're doing is potentially reducing trade with other countries, and that can have fallout impacts. There can be some retribution, some retaliation. There's a lot of things that can happen on the trade front that I don't think we've had enough time to have them materialize. So there's been a lot of banter about it, but not necessarily a lot of action. That's a potential risk if they do decide to be a little bit more inward looking on the trade front. There is an expectation that at some point, some type of tax reform is passed. We don't know when, whether it's personal or corporate. I think on the corporate front, it would be extremely helpful and could be an added catalyst, because if we get reduced corporate taxes in states, that means corporations get to keep more money, which should help valuations. What might be a negative is if, in fact, no reform is passed. The market's probably pricing in some level of reform, some level of relief. And if that doesn't come to fruition, then, of course, they could reverse course in terms of the valuation uplift that they put into some of these stock prices. So at this stage, the two things I'd be focusing on would be trade and tax reform. And of course, at the end of the day, geopolitical risk, the situation in North Korea, which I don't think the generals will let get out of control. There's other parts of the world, the Iranian situation, which is just more a war of words at this stage. It's certainly not even remotely close to some type of physical aggression, and other regimes around the world that obviously Donald Trump has decided to focus on, such as Syria and Venezuela. These are all geopolitical risks. It is a lot of banter, not exactly a great deal of action, but at the end of the day, they are still risks that we have to keep into consideration here going forward, because, well, as I said, Donald Trump is putting them at the forefront at the moment.
Okay, great. Thank you.
United Kingdom and Europe. With respect to the United Kingdom, this one, it's become much more difficult to figure out what's going on. And it was complicated by the last UK election, where I believe, and this only makes sense, that Theresa May called the election believing that she had great support for the hard Brexit, that is what the British people wanted. And as it turns out, after the last election, we're not sure what the British people want anymore, because, of course, the majority was reduced for the Conservative Party. Labour picked up a great deal of seats. And, of course, the Conservatives were more on the hard Brexit side. The Labour Party was a little bit more on the we want to stay within the European Union. So we're getting mixed messages here from the referendum and the election, from the electorate in general, as to what it is that the British people want. It has forced Theresa May somewhat to change her tone. She is even now getting, it would appear, although some of the politicians would disagree, but challenges within her own party about the approach to Brexit, about the path they take, about the strategy they use. And it's come to the point now where some people are saying, hey, if this keeps up, we might not even have Brexit, because we won't even be able to figure out what it is that the government wants to do, what they're going to be able to achieve, what they're going to be able to negotiate. The Europeans, of course, will probably play hardball. So it is very hard to have a crystal ball on this one as to, I mean, the process has started. The negotiations have started. Supposedly it will be 2 years worth in which they have to come to an agreement. And there's a lot of people out there that say that they're going to need a heck of a lot more time to pull this off, and maybe get some sort of arrangement, maybe like Norway, which was supposed to be a tentative agreement for about 11 months and has turned into, I think, a full-time agreement for 24 years. So in terms of the UK, right now, I mean, there is an expected fallout if a hard Brexit actually happens, because there will be a great deal of economic relationships that will be broken down if, in fact, they do break away. But at this stage, I think people are starting to move more into the camp that nothing's going to happen anytime soon. And so it's just business as usual in the UK. And I can tell you, I just returned from London, from the UK, from visiting family. And the whole idea that in terms of workers, that there would not be a free path for foreign workers, or at least European workers, to work in the UK, that would be ended, would, I think, be catastrophic to London, because no matter where I went, and no matter who served me, whether it was in a restaurant or a hotel or a store, I didn't see a lot of British people, or I should say people that were born in Britain that had British accents actually served me. They were, I could tell, from all over Europe. So it's going to be very interesting to see. I'm sure all the people that are there already will be given some sort of amnesty to stay. But in terms of preventing anyone new from coming in, they need these people from Europe, quite frankly, in London. There's just far too many jobs in the service industry that need to be filled, and I'm not sure if they can do it domestically or with naturally born British citizens. So I'm very curious to see how that plays out. But again, I won't be able to update you on this, I don't think, for a number of years. And I think people are now starting to focus back just on the underlying fundamentals of the UK economy, which are not terrible. The pound has taken a hit. It was great for me to go over there now with the exchange rate about 165. Historically, that's relatively quite low. Back in 2004, I remember paying 240 for Canadian for 1 British pound. So the pound has taken it on the chin. The markets are not overly convinced that the absolute worst is over for the UK just yet, because the pound is struggling. But the stock market has been doing reasonably well, considering what the prognosis is for the future. And when we look at the rest of Europe, the fundamentals in Europe have actually been quite strong this year. We're seeing a rebound in a lot of statistics across a lot of different countries. There was a great deal of political risk at the beginning of the year because of what people were calling the Trump effect, that there was going to be a negative change in leadership in France, potentially in Germany. We've had the French elections. It would appear as though the markets are extremely content with Mr. Macron as president. There were some concerns that Angela Merkel was going to be booted from the chancellorship of Germany. Those fears have abated, and I believe her election is coming up within the next few weeks, and she is expected to return to power. So it's, I think the markets are a little bit more relieved that it is a bit more status quo here, considering all the change that we had last year with the Brexit vote and with the US election. And certainly, I think there will be now a bit more focus in Europe on fiscal spending. They have been cutting back significantly on everything since the market crash of 2008, quite frankly. And there will be some pressure here, especially on Germany, since they have such a great influence to allow a lot of these European countries to start spending more and investing in their own domestic economies.
One thing about the whole Brexit situation, before we move on to the next slide, Gareth, is you know, we're hearing a lot of news about financial companies that are going to start moving offices, or or maybe redeploying their employees outside of the UK into other parts of Europe. Is that happening yet, or is that going to be happening?
Absolutely. I think that a lot of the big international banks have already taken steps and making contingencies for what they're going to do. Dublin, in particular, has been identified as a possible new home for some of these European operations. Either that or some places in Germany have been hinted. I don't think that these banks are going to wait around to find out what the final deal is. They're taking action now to say, look, you've said you want to leave. You're going to leave this union. We need to position our European operations in an office that is part of that union. And you're telling us here that London will not be that place. So I've heard of banks such as JP Morgan already shopping around trying to relocate employees. And so this is a process that I think is well underway already.
So that hasn't rippled into the economy yet then of the UK. Is that safe to say? Or
yeah, I think that is safe to say. As I said, they're probably still out there identifying where they're going to move, trying to find office space, trying to relocate their employees. That's something that's going to take months. And I don't think that we've seen the full swing effect of that transition yet. That will happen over time, though, for sure.
Okay, great. Thank you.
Within Canada, sorry about that. And within Canada, I'll tell you, I've been very surprised about how strong this economic data has been. There are certainly beliefs that the reason why it has been as strong is because of the real estate market. It has contributed a significant portion towards the GDP growth. But I think we all can recognize that the growth that we've seen in certain markets, such as Vancouver and Toronto, is not necessarily sustainable at the rates at which they've been growing. And in fact, we've already seen a bit of a pause in Vancouver earlier this year, and we are now currently seeing a little bit of a pause in the Toronto market. So with that said, while the data has been strong, I'm not sure that we can sustain it. And my biggest concern about the Canadian economy and why I have not been as bullish as perhaps the actual data has shown is because, for me, private investment is the key to growing an economy. You cannot rely on government spending to grow the economy because that is unsustainable. Deficit spending is not a great policy for stimulating growth for the long term. It can be for the short term when you can eventually rein it in, but the current strategy that we're pursuing of deficit spending for the longer term over the next supposedly 10 years is not necessarily something I'm totally in favor of, simply because I don't see any type of plan to pay the debt back. Private investment is so key because what that means is it's not just domestic, but it's foreign money coming into Canada to help create jobs. And, you know, within 35 million people in this country, it's very hard to have high growth rates without the influence of outside capital flows coming into our economy. My biggest concern from the oil price decline, of course, was the fact that private investment declined in the oil patch up to about 40 to 50, 60 billion dollars. We need to find a replacement of that capital to continue the growth that we've had. I'm not sure if we've necessarily had that hole filled, but certainly the stability in the oil price has perhaps halted the exodus of some of that capital. But when you think about the Canadian economy going forward, it's very key, I think, for future growth for us to see foreign inflows coming in to invest in this country. And after the most recent resource cycle, we know that obviously those investment levels are not as high as they were. So that's something to keep in mind as to why I'm still a little bit cautious about some of these growth numbers that are coming out of Canada, and the fact that I don't expect them to continue going forward. Yes, you know, we have been using government spending at the federal level in particular to stimulate the economy. I just don't find this as a sustainable strategy that's really going to be helpful for the long run. Yes, there was I think an announcement yesterday. The deficit was, I think, $5 billion smaller than expected, but it's still large. It's still growing, and it's going to continue to grow. So there are some concerns there. Consumer debt, I've talked about this on previous calls, so I won't go into great detail here, but, you know, with rates starting to go higher in Canada, this will not be an issue this year. It might not even be an issue in 2018, but, you know, 2019 and beyond, if rates continue to climb, the cycle of people renewing their 5-year mortgages starts to turn over, then you're going to start to see, I think, the impact of the higher debt levels out there at the consumer level, perhaps, on personal spending and on the Canadian economy. Housing, you know, it can help the economy, which is great, but again, the rate of growth that we've seen in certain markets is not something that can continue. So we have to take that in consideration in terms of setting our expectations going forward. And finally here with the Bank of Canada, I've already mentioned why I was surprised. We weren't expecting rate hikes this year. We have had 2 already, potentially a third coming by the end of the year. At least, you know, instead of dwelling on why it happened when we didn't expect it, it's just more a key here, I think, to focus on the fact that, hey, we are in the cycle now of raising rates. Get used to it. There's more to come. We have to adjust our expectations accordingly. And, you know, higher interest rates off such a very low base, I don't think is going to do detrimental harm to the Canadian economy in the very short term. But once we start seeing, let's say, interest rates, you know, 200, 300, 400 basis points higher, and of course is a couple of years down the road, then I think you're going to start to see an impact on consumer behavior and on borrowing, because there will be some people that maybe can afford their debt at current interest rate levels that might not be able to afford it at those higher levels when those levels come. So I don't want to sound bearish on Canada, but I am not in the camp that is overly bullish, which is what some people would suggest we should be, considering some of the economic statistics that have come out. I'm a little bit more cautious on that data, because I just don't think it's something that can keep on going on.
So one more thing before we go to the next slide with the respect to Bank of Canada and obviously the surprise. You know, they always, you know, Federal Reserve boards and Bank of Canada, you know, always refer to the fact that, or what they say is, you know, they don't tailor their monetary policies based on currency. But we're obviously hearing a lot of the, you know, the issues with a very strong dollar. Would they be taking that into consideration, you think, in the next possible rate hikes?
Potentially. You know, their focus tends to be inflation. And I'm actually surprised that we've had two already, in that the inflation rate in Canada is not necessarily overly strong. It's actually a little bit below the level that the Bank of Canada is looking for. So I'd be surprised if we could become overly aggressive, because the inflation statistics are just not there to support higher rates. But can currency come into play? Sure it can. They won't necessarily admit it. But for example, if the loonie were to go from where it is now to 85 cents before December, the Bank of Canada might just say, okay, we don't need to move right now, because the higher currency is probably slowing down our economy for us, as opposed to us having to raise rates to try and pull back some of that growth. So while there is no direct relationship drawn with respect to currency and interest rate policy, there is a little bit of an indirect relationship that the central bankers will take currency into consideration if in fact it's at an elevated or way too low level going into any particular meeting at any particular time.
Okay, great.
The oil price, I won't spend too much time here, because there's really not a heck of a lot to talk about, because we haven't seen a great deal of movement. As I mentioned, we're up above 50 beginning of the year. We dipped down below 50 essentially through the summer. We almost touched down around the $42 level. Not a great deal of volatility compared to what you can see earlier in this chart, going back to 2015, 2016, when we were up by 20 bucks, down by almost 40, 50 bucks, and then up by 20, 30 again. We're not seeing those types of movements. We're not seeing erratic volatility, which I think is good for the oil space because they can now budget and plan accordingly with some stable oil prices. And admittedly, as I said earlier, I'm sure Calgary would love to see higher oil prices, but I think there's even some admission and capitulation in the oil regions of North America that prices, for the most part, aren't likely to go a heck of a lot higher for the rest of 2017. We are seeing a little bit of manipulation, supposedly by OPEC. The Saudis, of course, would like to see prices reasonably stable before they do their big IPO of Saudi Aramco, which might not even happen now for some time. But needless to say, there isn't a great deal of chatter out there about oil prices at this stage going excessively higher, or even, quite frankly, excessively lower either. Demand obviously is stable, with the economic statistics globally supporting that, but we also still have a great deal of supply coming from around the world. So as I said, at this stage, it's a bit of a neutral story compared to what it might have been before when I've done WebExes, where we've been a little bit all over the map on the oil price. I'm just going to, I've shown this before, and it's because I'm going to talk about the TSX index, just highlight the fact that it is very sensitive to commodity prices. As you can see, 2015 was horrendous. 2016 was a rebound year. And as you can see here, 2017, this is as of the end of August. Essentially, you kind of got half of our commodities up and half of them down. And if we translate that over into the actual TSX index, as I said, 2015 was horrendous for commodities. Well, guess what? 2015 was horrendous for the TSX. We had a rebound in 2016 commodities. We had a rebound in the TSX in 2016. And if you go to 2017, as you can see, with half commodities up, half of them down, the index has been flat. I think we're up by a fraction of a percentage point at this stage.
Yeah, year to date.
For 2017. I think you can look to the commodity space to explain most of that movement, because we've had mixed performance at the commodity level. Meanwhile, our financials have been relatively stable. So if you're looking to explain why the Canadian market has underperformed, let's say the American markets, you can certainly look to the commodity space as one of the reasons why that difference has occurred. And finally here, the Canadian dollar, if we kind of rope everything in together that we've talked about today with respect to interest rates and oil prices, and those tend to be the two biggest influential factors on the Canadian dollar. Obviously, oil not really moving the currency as much now as it used to previously. And certainly you can see that 2013 down to 2015, that was predominantly oil price driven. Right now, I'd say monetary policy and interest rates are the key driving factor. And we've had a tremendous amount of strength in the loonie ever since, of course, there's been hints and actual movement on the Bank of Canada to raise rates higher. Getting up above, that 82 cent level, I thought was extremely impressive. Would not be surprised to see us have a bit of a pause here. unless the Bank of Canada ends up being more aggressive than we expect. And I'd be surprised if they were overly aggressive. Again, I refer back to the fact that inflation is not out of control, and if anything, is just a little bit below what the Bank of Canada wants right now. So there's no need, I think, at this stage to overdo it on the rate hikes going up. If we keep pace with the Americans, then perhaps we could see, let's say, another 4 interest rate increases in Canada before the end of 2018. And that's just following these expectations of the states being December and 3 more next year. And if we kind of move in lockstep with the Americans, then you won't necessarily see a relative surge in the loonie because we'll just be kind of keeping up with our neighbors. But, I would say at the beginning of this year, a question that I was commonly asked is, are we more likely to see 70 or 90 cents at some point? At the beginning of this year, we probably definitely would have said 70, just because of the expectation that no rate hikes were coming and that the Americans were going to move. Now, that viewpoint and the sense of where the lootie's headed, some people would probably be answering 90 cents instead because of the fact that we moved when that was not expected. So risks to the loonie to take us lower, of course, is that this is it. You've had 2 rate hikes and we paused for some time. I don't think that's the Bank of Canada's intention at this stage, or else they wouldn't have raised at the last meeting. They would have waited probably until the next one to do so. However, I think there are some investors out there that would like to see the Bank of Canada be a little bit more patient to see what the impact of some of these rate hikes are on the economy. And unfortunately, we don't usually see the impact of a rate hike until, let's say, 6 months after the interest rate increase actually happens. So the risk here also is that the Federal Reserve becomes a little bit more dovish in that they don't raise rates as much as expected. And the reason why that's a potential risk is because there is some speculation about whether or not Janet Yellen will be returned as the Fed chair. President Trump will have to make that decision shortly as to whether or not he wants Chairwoman Yellen to stay on, or whether he wishes to change things up a bit at the Federal Reserve and not appoint her again for another term. If he does not, then the questions are, who does he pick, and will that person be hawkish or dovish, in other words, bullish or bearish on the U.S. economy? And of course, that's going to influence policy going forward. So I don't think the risk here for the Canadian dollar is going to be driven by resources, because I think global growth is still supportive of at least where current pricing levels are for resources. But certainly interest rates is going to be the talk of the town when it comes to forecasting the Canadian dollar going forward. And the good news is, certainly if you're a snowbird, this couldn't have happened at a better time for you. We are going into the cooler months of the year with the loonie at its strongest that it's been since 2015. You can't necessarily be unhappy about that if you spend a lot of your time in the winters down in Florida or any other southern U.S. state. At this stage, we're not seeing dramatic moves, or we're not expecting dramatic moves from where we are. We could dip below 80 cents again, but I don't think we're going to revisit that 74-cent level that we were at in the spring, because the Bank of Canada has basically announced its intentions that it expects to move with other central banks, such as the Federal Reserve, and as other central banks around the world, not necessarily increase rates, but reduce the monetary stimulus that they've been putting into their interest rate policy, or I should say into their markets over the past 10 years, quite frankly. So that's the outlook for the Canadian dollar. And with that, I will turn things back to Frank.
Wow, that's great. Thank you, Gareth. As we mentioned, there was a lot of meat to sink our teeth into today. And, who would have thought in January that we would, our WebEx would be dominated by interest rates, right? So lots of information for us to take back and to assess. But I think the takeaway from this, excuse me, is really the benefits and the importance, again, of diversification. The Canadian market, which did well last year, is underperforming. The global markets are doing much better, but with the strength of the Canadian dollar, it's muted it a little bit. But at the end of the day, it's really, the driving force of portfolio returns for us is asset allocation. We look forward to the fall, and hopefully this summer extends a little bit further out, which, as I mentioned, is happening here in Toronto. So till our next WebEx, I want to thank Gareth for your insights. And on behalf of the Hortensio Group, I want to thank you for entrusting us It is a responsibility that we do not take lightly. So stay tuned for the next O report, and happy fall or happy Thanksgiving shortly.